Well, joining me in the On the Money studio to discuss this, a panel of grown-ups who know what they're talking about as ever. We've got wealth advisor and economist Jonathan Davis, also joined by Vicky Pryce, Chief Economic Advisor at the Centre for Economics and Business Research and On the Money regular. Welcome back to you, Vicky. And joining us from South East London, we have MIATTA FAHNBULLEH, who's Chief Executive at the New Economics Foundation. Welcome to you all. Thank you for joining me. Vicky, let's turn to you first. We've been looking at the numbers since this morning. It's a pretty chunky slug of borrowing in August, so much higher, 4 times higher than in August before the pandemic.
Well, we shouldn't be very surprised because it was predicted. After the 325 billion borrowing we did last year, the expectation has been that we'd borrow something like 250 billion this year. So the market had already expected it. We're already anticipating it, with the result that yields on 10-year bonds have remained quite low. In other words, the government is still able to borrow very cheap.
That's right. Jonathan, what do you think? Vicky's instantly put her finger on the nub of the problem. It's what financial markets think. Will they keep buying government debt? They're still buying government debt cheaply. On the other hand, it's not financial investors who dominate the market for government debt. It's the Bank of England.
I would actually say that what's more important is the commercial banks and their lending, in other words, what we call broad money. They are the ones who create all the increase in money supply in the economy. And as Friedman said, inflation is always and everywhere a monetary phenomenon. We're creating money out of thin air at a greater pace than any time in peacetime. And we clearly have rising inflation now, which means that the working and middle class are going to lose out. And I believe that due to government, Bank of England, banking policies, we're going to have rising inflation for perhaps decades, which means that the economy is going to be stifled because no economy does well in rising inflation, rising cost of living, rising cost of doing business.
OK, hold that thought. We'll come back to that. MIATTA, let's come to you. Thanks again for joining us. What did you think when you saw this government borrowing number today? Are you worried about the size of our national debt at all?
No, not yet. And I'm not worried for 2 reasons. Partly because I don't think they had a choice. And for me, I think the counterfactual is really important. Imagine if the government hadn't stepped in through the pandemic. Imagine if the government hadn't done furlough. Imagine the long-term scarring to our economy. So there was a cost. There is a cost to not spending. There's a cost to not borrowing. And for me, that cost has been far, far higher. So we knew that we had to spend a lot. They were being told by every reputable international organisation, from the IMF through the World Bank, you've got to spend your way, you've got to protect your economy, was the right thing to do. And then the second thing that has helped is the cost of borrowing. You know, interest rates are at historical low, and yes, the government has had to borrow a lot, but the cost of financing that debt is ironically at historical lows. So for me, the fundamentals are such that we didn't have a choice, but we're not at the point where I think we need to panic about this.
That's well put, MIATTA. You're an economist, and I know you think hard about these issues. So let me put this to you. You and Vicky, with respect, said that the market seems relaxed about this. The cost of borrowing is historically low. But I put to you the same point I made to Jonathan Davis. It's the Bank of England that's dominating the market for government debt. The Bank of England now holds almost half of all our outstanding government debt. It's the Bank of England, with its massive money printing programme, that's setting the price of government debt. So you can't say that the markets are relaxed. The market is irrelevant at this point.
Yeah, so look, the Bank of England has stepped in, and actually of the debt that's been accumulated by the government over the course of the pandemic, the Bank of England has basically hoovered up about 98% of it, I think, if not 100% now. So, you know, there has been a huge monetary policy intervention in the economy. Again, I'll go back to the fact that I think the Bank of England was right to do that. Their judgment was the government had to spend in order to get us out of this pandemic. And if you could use the lever of monetary policy in order to enable the government to do that, that was the right thing for the long health of the economy. The critical thing, and this is a different intervention, so it's really important for me, the role of the Bank of England, because it does mean that, yes, the government has borrowed, but it's borrowed on relatively favourable terms from the Bank of England. Not directly, the Bank of England has to buy it out of the secondary market, but essentially the Bank of England is underwriting it. So the pressure to repay that debt because you have a lender that's not a favourable lender is just not there. And I think that shifts the dynamic around fiscal policy and monetary policy, takes us into a new frontier that requires, I think, the government to think differently, and indeed for commentators and people to think differently about our debt burden, what is sustainable, and at what rate we need to start paying it down.
Tell you what, we'll come back to QE a bit later in the discussion. For me, it is the underlying fundamental issue that we're facing when we talk about our public finances in this country. I think all of us agree it's very, very important. But just before we get to that, let's just talk in more conventional terms about fiscal policy. Vicky, you've had a few days now to digest those tax rises that Boris Johnson unveiled on top of tax rises coming in the form of higher corporation tax. A lot of whether or not we should worry about our national debt, and I probably worry about it more than you, I acknowledge, is can we grow? Can GDP keep expanding so debt as a share of GDP falls or is sustained? Are you confident that even with these tax rises, the economy can keep growing?
I'm not fantastically confident, no. I think there is a rebound, there's no doubt about that the economy has been coming up from very, very low levels. And when we worry about, let's say, inflation, which is a big issue right now, we need to remember that a year ago we practically had deflation.
Yeah.
So yes, of course, some people are suffering because of that, but we've got to look at history a little bit. And that will hopefully be a transitory phenomenon, but remains to be seen. But the real worry is whether there's been any serious investment in the past that may perhaps be reignited. You know, the government has given quite a lot of support to people who might be prepared to invest through the extra capital allowances it's allowing for the next couple of years. So that's quite significant. We've seen and are seeing investment in renewables happening and so on. But in reality, if you look at the UK in particular, it has suffered very low investment in relation to GDP for a long period of time. And you mentioned in your introduction what's happened from the financial crisis and the debt, of course, that was accumulated then.
Yeah.
One of the reasons why that debt was accumulated was, again, because the economy wasn't growing anything like as fast as it should.
We
didn't invest.
We never really got out of second gear after the financial crisis. It was like 1%, 1.5%. Before the financial crisis, of course, we were used to 2.5% growth as the kind of mean. It seems we're on a real low growth trajectory, even before COVID and coming out of COVID even. We had 0.1% GDP expansion in July, I think, basically flatlining. But in historic terms, how important is growth in getting debt under control?
Hugely important. Because, of course, you can do all sorts of things. If you raise taxes, of course, someone perhaps will not invest as a result. And perhaps people are not going to go out and spend as much as you want. So
we're still discussing here on The Money Britain's spiralling national debt. My guests have been waiting patiently. Should we be worried that government debt is now 97% of GDP? I'm with Vicky Pryce, friend of the show. Jonathan Davis, economist and wealth advisor. MIATTA FAHNBULLEH joins us down the line as well. Jonathan, thank you for your patience waiting while we dealt with that breaking story. To what extent are you worried that these tax rises will curtail growth? You spend a lot of your time following equities, looking at companies, deciding where you and your clients should invest. Are you worried about the growth outlook?
I'm worried about the growth outlook. The tax rises are just more taxes from basically socialist governments. This is not a Conservative government, but that's another discussion. What I'm concerned about more is the total debt in our society is over 300% of the size of the economy. It's commensurate with other...
When you add up household debt, corporate debt, plus state debt.
Thank you. It's commensurate with other similar developed economies. But the issue is the debt is going to rise and the inflation is going to continue. Why? Because, going back to your very first point, the Bank of England, the Federal Reserve of the US, the European Central Bank, Uncle Tom Cobley, they are going to, if they haven't already started it without telling us, establish yield curve control. What that essentially means is they're going to keep interest rates down basically forever, and that is going to push inflation up forever. You and me are going to be hit hard forever.
So you think, if we look back to national debt after the Second World War, the early 60s, as I said the last time it was up at this level, it was a combination of growth and moderate inflation, in some cases not so moderate. In the 70s, it was double digits, that eroded away that national debt. So you think
yes.
that we're not going to solve the national debt by taxing more or spending less. We're going to solve the national debt with a bit of inflation, a bit of growth, hopefully more growth, but inflation if we can't get the growth.
It won't be a bit of inflation, it'll be a lot of inflation. And it's interesting you mentioned the Second World War, because that was just afterwards, that was the last time we had yield curve control. Exactly the same situation. It'll be very costly for 90% of the population for the next decade or two.
MIATTA, thank you for your patience as well, waiting with us while we dealt with the Home Secretary's statement. Welcome back to you. Are you concerned at all about inflation? 3.2% in August. You look at inflation, input prices, what factories have to pay for the things that they need to make goods, what service providers pay to provide those services to us. Input price inflation, 10% in July, 11% in August. Don't you think a lot of inflation is coming down the track?
So I'm not worried yet. And the reason I say that is that, we've gone from putting the economy on deep freeze to opening it up. There was always going to be inflationary pressure. I think the big question is it temporary or is it sustained and long-standing? And the truth is we just don't know yet. If you listen to the Bank of England, they're telling us at the moment we're not worried. We think it's temporary. We're seeing the same inflationary pressure in other countries. Again, their policymakers are saying we're not worried. We think it's temporary. If it looks like it isn't temporary, I think that is a problem. And I care about it more from a cost of living perspective. A lot of people have been really, really hard hit by this pandemic. Many of them are losing support from the government, universal credit uplift and other things. And the idea that we can see, big pushes in the cost of living, I think is a problem down the track that will not just stifle growth, but actually will hit people, hit their pockets. But at the moment, I'm not worried. I think it's too early to tell. We always knew there would be some inflation. That is inevitable when you suddenly close an economy and open it. So let's see. And I think the Bank of England is taking the right approach on this.
The Bank of England, though, has acknowledged, as you'll have noticed, MIATTA, we could have inflation of 4% by the end of the year. That's their estimate now. It took them a while to get there, in my view, but they're there. And that's double their target. So shouldn't they be taking measures to rein in inflation if it's going to be 4% on their own reckoning by the end of the year? Whether or not that's preparing the ground for interest rate rises, or at least not carrying on with quantitative easing. They're still basically creating out of thin air billions of pounds every month.
Well, their judgment will be there's a balance. There's a balance between, choking the recovery. There's a balance between, the need to continue investing. Some of it is, we're still in a pandemic. We're still dealing with the aftermath of it. The NHS is still under pressure, and those are real issues. So I think there's a balancing act that says, this is where we think we'll be by the end of the year. Is that the long run trajectory? Is it a short-term blip? And what we don't want to do, if you are the Bank of England, is move too quickly and choke the economy, move too quickly and stop the capacity of governments to invest in things that will be absolutely vital for us to not just get out of this awful pandemic, but to have some hope that the sort of economy that comes on the other side of it is better than the economy that we left behind us.
Vicky, let's turn to you, and thank you for your patience as well as we covered Priti Patel's statement there from the Commons. Let me put this to you. I don't know a single business which isn't investing because interest rates, aren't are low. I guess my point is, MIATTA talks about choking off the recovery. I don't think a quarter-point interest rate or a half-point interest rate rise is going to stop investment. I don't think ending quantitative easing will stop investment. I don't think people in the real economy, ordinary firms, care about that. In fact, they're spooked by QE. They're spooked by endless low interest rates, ultra low. What we're really talking about, if we're honest, is not upsetting financial markets. That's the real issue. That's Andrew Bailey's nightmare, isn't it? The Governor of the Bank of England raising interest rates a bit from their currently, in my view, absurd levels, and financial markets getting upset.
Of course, not just here, but all across the world. We see what's going on in the US, where course, they have been buying 120 billion US dollars worth of bonds. That's the Federal Reserve every month. And
this is historically unprecedented.
In Europe as well,
right?
Yes. Everyone's doing it. So the markets are now quite happy, saying that, you can actually survive with quite a lot of debt. So there's been a change in perception that you can survive and not be a bankrupt nation, even if you have debt to GDP ratios which are over 90%, which was considered to be the cutoff point.
Yeah.
Once you move beyond that, capital markets will react. You're never going to be able to borrow or grow at the rate that will then repay the interest that you have to pay. And that was really what was going on. Now the markets believe you can do differently because, of course, we've had the central banks intervening very significantly, and also the blessing from the IMF, the World Bank, and so on. But what businesses are worried about, in my view, is how to then continuing financing the debts that they have been amassing, if you like, during the COVID crisis and before, because we did have a debt-laden market.
As Jonathan Davis said,
Which has been a problem, by which I mean sort of companies, borrowing heavily. And, of course, through the COVID period, government had stepped in very significantly by guaranteeing debt for firms, and therefore banks have been giving quite a lot of those loans that, of course, have now come to an end in terms of providing more of those. They've been replaced by things which are much more onerous because you have to put collateral down, property and so on, and the interest rate is higher. So interest rate increases might indeed, even though there are special arrangements with what they've got at present, might indeed affect the willingness to even continue in business because they won't be able to afford any more borrowing that they may need to make. And that, I think, is the issue.
With all respect, such companies need to fold. I mean, zombie companies don't do anyone any good. They're not investing, they're not innovating, they're not adding to growth. They're a net drain from the economy.
You're assuming, of course, that all those firms that won't be able to survive are zombie companies, but they've been hit by exceptional circumstances. And it's a similar issue right now with the energy price increases that we're seeing. The government seems to be saying, well, let all those energy companies go. If they weren't able to survive with this increase in wholesale prices, it must be something wrong that they're doing. But nobody was really anticipating such an increase as we've seen now. So it's questionable, frankly, whether those firms are zombie firms or whether they should be supported.
One more short contribution from each of you. Again, I apologise that our discussion was truncated. Jonathan, what do you think are the limits on QE? How much longer can we go on printing money effectively in order to buy government debt? The Bank of England says that it isn't quite what it's doing, but that is basically what it's doing, as everyone can see.
I refer you to my last statement, Your Honour, Mr Speaker. The central banks of the world will continue to do what they're doing ad infinitum, and they will actually create more inflation, which will make the situation even worse. And nothing will stop them because that is what they've decided to do. They've decided to keep on bailing out, as you say, financial markets to the detriment of anything else, and the real economy will be hit hard. That means the real people of the United Kingdom.
MIATTA, your final thought. How long can QE go on? We've had Andy Haldane, the former chief economist, saying he'd end QE now. Even Dave Ramsden, another member of the MPC who's still there, very senior figure in our policy-making establishment, he's talking about ending QE. Now, surely this can't go on forever.
It can't go on forever, but I think it could probably go on for a little bit longer. But what I would like to see is, if the government, if the Bank of England is creating money, that should go to the real economy. So when we actually looked at the first round of QE that was done, a lot of it did go to propping the financial markets. Barely any of it went to the real economy. When you look at the amount of finances that then flowed to, for example, SMEs, it was something like 2%. So I think that there's probably the scope for monetary policy to continue using the lever of QE, not least because they don't have that much flex through, taking interest rates any lower. But let's be smart about it so that it goes to investing in the real economy, so that it goes to, for example, investing in the green economy that we want to create, so that out of this short-term, if you like, intervention that I think is quite unique, comes some upside that makes the economy better, stronger on the other side of it.
Had the last word in this discussion. MIATTA FAHNBULLEH, thank you for joining me here on The Money. Jonathan Davis, wealth manager and economist, and, of course, friend of the show, Vicky PRYCE, thank you for coming in.